Welcome everyone to our weekly Outlook webinar. My name is Ilian Yotov. I'm the creator of the Quarters Theory method and also the founder of allthingsforex.com and tradertape.com. I'd like to thank our friends from fxstreet.com for putting together these webinars, a series of webinars for us. And if you would like to follow up with me on a daily basis, Monday through Friday, for my analysis on the currency markets, you are welcome to visit allthingsforex.com and listen to my daily All Things Forex broadcast. Once again, the website is www.allthingsforex.com. Now, today we're going to discuss the trading week with June 13th through June 17th. And this is in my opinion, a transitional week. Why am I saying that? The reason I'm saying it's more of a transitional week is because the big events come the week after next week. And by the big events, I mean really, really big events. On June 20th, which is the week after Monday, we're going to see the Eurogroup Finance Ministers meeting. That's on June 20th. Then, on June 21st and 22nd, that's the week after next week, Tuesday and Wednesday. June 21st, 22nd is the Federal Reserve monetary policy meeting. And then on June 23rd, which is Thursday and Friday of the week after next week, we're going to see the European Union Summit. And now the clock, many of you know that the clock is ticking for the European Union officials to provide solutions, new ideas as to how to deal with the European Union debt crisis, how to bail out Greece and contain the crisis. And as the market's attention now shifts onto that fateful week that is coming up after next week, I think that throughout next week we're going to see a lot of market jitters, perhaps. More than likely, a lot of uncertainty once again as far as what the outcome of these meetings is going to be, what will be the solutions proposed for Greece, are there going to be any agreements or disagreements on how to deal with the debt crisis going forward. And then ultimately, besides all of that, throughout next week the markets will focus on inflation, as we're going to have the main gauges of inflationary pressures from some of the world's largest economies, and that's China, the United Kingdom, the Eurozone, and also the United States. So inflation and the European Union debt crisis are going to be back in the spotlight throughout next week. Now, besides that, throughout next week, we're going to also have two interest rate announcements from two major central banks. That's Bank of Japan and also the Swiss National Bank. I'm not expecting that neither one of these two banks are going to change their monetary policies next week. More than likely, they're going to keep interest rates unchanged. And we'll talk about that in a couple of minutes as well. Then we also have some important economic data that's coming from the United Kingdom and the United States throughout next week, so we'll cover that. So I mentioned earlier that inflation is going to be the main focus of the week ahead. And this is why I've chosen the very first economic event of the top 10 events that I've chosen for next week to be an inflation report, the Chinese Consumer Price Index, which is the main measure of inflation in China. Perhaps many of you already know that a lot of experts even feel that the Chinese government has already has even possibly lost their grip on inflation. Chinese inflation is above 5% once again in the last several months, climbing back above 5%. It was up 5.3% year over year in April. Now, the consensus forecasts are pointing to inflation pressures in China rising once again for another month in May to 5.5% year over year. What does that mean? It means that inflationary pressures in China are basically going to continue to remain elevated, and elevated inflationary pressures increase the odds for a central bank to consider hiking interest rates in order to curb inflationary pressures down. Now, the People's Bank of China, which is the central bank of China, has already risen interest rates multiple times. And if inflation continues to rise, we could see an increased probability for yet another interest rate hike to come in the near future from the People's Bank of China. On top of that, the Chinese government is also making efforts to cool things off in what is now the world's fastest growing economy. It's the second largest economy in the world, the Chinese economy, that is. And it also is the world's fastest growing economy. So if we get to see inflationary pressures getting out of hand in China, then obviously the government has to take these steps in order to contain it, and that could mean possible economic slowdown. Raising interest rates, as the People's Bank of China has already done, raising the reserve requirements for banks, limiting the amount of loans and so forth. Those are one of the things that they have done already in order to cool things off. What does that ultimately mean for the rest of the world? Well, if the world's fastest growing economy slows down, then that could have an impact on worldwide economic growth. On top of that, the biggest impact of that would be to the Chinese trading partners. And Australia, as we've discussed many times on this program before, is one of the largest. China is actually the largest trading partner of Australia. It is the second largest trading partner of New Zealand, with Australia being the largest trading partner of New Zealand, and then number two being China. So obviously these two higher yielding commodity currencies, the Australian dollar and the New Zealand dollar, could be directly impacted by any kind of Chinese economic slowdown, as it could have a negative impact on their economies and ultimately reduce the demand for these two currencies. China is still demanding a lot of raw material exports from both of these nations, Australia and New Zealand. But ultimately, if that demand were to slow down, then that is what I meant when I said that it could have a negative impact on these two currencies and the economies there. Let's go ahead and take a quick look at the daily chart of the Australian dollar versus the US dollar. Okay, here we go. Let me know if you guys can see it. Now, in the last couple of weeks, we've drawn the current range that the Aussie dollar exchange rate has been trading within pretty much for the entire 2011 so far. You can see that I've pinpointed here the important price levels in my quarters theory of the actual large quarter points within the 1,000 pip range between the parity level at $1 and $1.10. You will see here is the major large quarter point at $1, and you can see that pretty much since the beginning of 2011, the Australian dollar has been trading for the most part, with very few exceptions for a few weeks or a month or so, below the parity level. But for the most part, the price action has been taking place so far in 2011 between the major large quarter point at $1, which is also a major whole number as I like to call it in my quarter theory, and the large quarter point there, the major large quarter point above, which is the $1.10 level. That is the 1,000 pip range that, when divided in 4 equal parts, as I do with my quarters theory, I divide every 1,000 pip range into 4 equal parts, or 4 large quarters of 250 pips. So you'll have $1, $0.0250, $1.05, $0.0750, and then $1.10, giving you the 4 large quarters. These are what I call the large quarter points of that 1,000 pip range. So most recently, the Australian dollar has actually reached as $1.10, what was it, $1.10.010 or $1.10.11, which is the new record high for the Aussie against the US dollar. And then after that, the Australian dollar went through a significant price correction, as we anticipated, by the way, a few weeks ago on this program. I said that we could see a significant price correction that's been long overdue, simply because the Australian dollar rallied from about 0.97 cents all the way up to $1.10, which is over 1,300 pips of a gain. and a very strong bullish trend has been established, but a more significant price correction we estimated that could bring the Aussie dollar pair down to at least the large quarter point, which is this level here at the $1.05. So in the recent couple of weeks, the $1.05 level has been serving as an area of support, and we had a little bit of a lower low at the $0.0440, a little bit below $1.05. That would be the ultimate bottom of the current range, which is for the most part, again, between the large quarter points at the $1.05 and the large quarter point above at the $0.0750. Most recently, the Australian dollar failed to break above this resistance that I pointed to you, which is a little bit above $0.0750 at the $0.0775. And so the Aussie dollar pair stayed stuck within that 250 pip range. Last week we spoke whether the Australian dollar could find the catalyst for it to break higher and to complete the next large quarter of 250 pips. With my quarters theory, I should mention here, for those of you who are not familiar with my methodology, with the quarters theory, I propose that every significant price move takes place from one large quarter point targeting another large quarter point. In other words, that there is no chaos, no randomness when it comes to fluctuations of prices, but rather that they move in an organized manner in a systematic effort to complete the large quarters of each 1,000 pip range. And so, we said that if the Australian dollar does not find the catalyst to propel it significantly above the large quarter point at the $0.0750 and above resistance at the $0.0774, then the Australian dollar could easily get stuck in a range. All you have to do is go listen to the program from last weekend. And then we said that the bearish scenario for the Australian dollar, if it were to fail to break above the top of this existing range and above the $0.0750 large quarter point area, would ultimately result in a possible move that could challenge the large quarter point at the $1.05, which is close to the bottom of the existing range. The most recent lows on Friday were $1.0525, which is exactly 25 pips from the targeted large quarter point at the $1.05. So for the most part, that move has already been completed. And if the Australian dollar continues to weaken, especially if Australian inflation gets out of hand and it increases for another month, raising the odds that the Chinese inflation. If Chinese inflation increases and we get to see more steps that are anticipated by the market from the Chinese government to slow things down with the Chinese economy, prevent it from overheating, and prevent inflation from getting out of hand, then the Australian dollar could weaken additionally and challenge the support level, which is now the bottom of the range, at the $0.0440. If the Australian dollar does not manage to break below $1.05 in the $0.0440 area, which is an area of about 60 pips, if it finds strong support once again within this area, then we can anticipate that the bottom of the range at that point could sustain. If it's not broken below, we could see possible opportunity for another trip perhaps to the top of the existing range, which is the large quarter point at the $0.0750. For the most part, however, this is a range-bound currency pair. It is trading within a range, which is approximately the range between $1.05 and a $0.0750 large quarter points. So, if the Aussie dollar pair breaks below $0.0440, we get to see more uncertainty on the Greek debt crisis, on the Eurozone debt crisis, more risk aversion, more weakness in equities. Obviously, that will be bearish scenario for the higher yielding currency, such as the Australian dollar, which normally tends to strengthen when there is a strong appetite for risk, but it also normally tends to weaken when we get to see significant risk aversion. And if that is that kind of a transitory, to use Mr. Bernanke's words, week that we're seeing ahead of the important events from the week after, and we get to see more uncertainty throughout next week, Australian dollar and New Zealand dollar and other higher yielding commodity currencies could come under additional pressure, along with the euro, obviously, which with the debt crisis there and the uncertainty of how the European leaders could deal with containing the crisis, could continue to weigh on the euro as well throughout next week. Now let's go ahead and take a quick look at the New Zealand dollar, which is another higher yielding currency closely linked to the Chinese economy. Most recently, the New Zealand dollar established a new record high versus the US dollar, and that was the high at 0.83 cents. 0.8300 was the high on Thursday of last week, and that is the new record high and a major resistance level, of course, ahead of us for the Kiwi versus the US dollar. The New Zealand dollar broke above the previous record high successfully. That was 0.8120. After that breakout, we said that we wouldn't be surprised to see the completion of the large quarter to the large quarter point at 0.8250. So, as I said a couple of weeks ago, hope that wasn't a surprise for many of you to see the previous record high for the Kiwi against the US dollar being close to the large quarter point at 0.8250 at 0.8262, which I classify as 12 pips of an overshoot above the large quarter point at 0.8250. We had a little bit of a price correction that took prices back to the previous resistance level. It even managed to move a little bit below 0.8120. But as I said earlier, do not mistake any kind of price corrections when there is such a strong trend. And I don't think that it takes a rocket scientist here to see that the trend is still strong, bullish trend for the New Zealand dollar versus the US dollar. So I said do not mistake any kind of price corrections necessarily for an actual trend reversal. So, as I explained in previous webinars, any kind of significant price correction or pullback from recent record highs for the New Zealand dollar can be considered by millions of traders out there as an opportunity to re-enter at lower price levels in anticipation for that strong bullish trend for the Kiwi to continue further versus the US dollar. So, off of the recent high, we have now retraced back to the large quarter point at 0.8250, and a little bit below that level, today's intraday low is actually 0.8197. So if that retracement continues even further, watch this level here throughout next week, which is the previous low from last week at 0.8071. 0.8071. Now that level is a little bit below the previous support level at 0.8120. That's previous record high resistance, which on the way down could easily establish itself again as a level of support. So this area between 0.8071 and 0.8120 is going to be a very important area. If that area is broken below, the Kiwi dollar pair could easily go down to the major large quarter point at 0.80 cents and maybe even lower below that level. But if 0.8071 support and 0.8120, if neither one of these two levels is broken decisively below, then we could see more traders coming in if the New Zealand dollar were to form a base around there in anticipation to reposition lower price level in anticipation for the bullish trend for the Kiwi to continue further. Be careful, however, as I mentioned with the Australian dollar earlier, that next week could be a very jittery, if you will, trading week with lots of uncertainty, lots of market jitters, economic data from around the world. All of these major economies does not seem to me at a glance, looking at some of the consensus forecasts, and we'll talk about that in a few minutes, it doesn't look like we're going to have a very strong economic data that's coming from the United States, the world's largest economy, and doesn't look like we're going to have very strong economic data from other economies as well throughout next week. And if that is the case, we could actually see more weakness in equities, more risk aversion, and that could weigh on the higher yielding commodity currencies such as the New Zealand dollar and the Kiwi dollar. Now let's go ahead and take a look at our second major spotlight event for next week, which I've chosen to be the Bank of Japan interest rate announcement. Of course, the Bank of Japan is now the last in line after the massive earthquake and tsunami and a nuclear disaster threat. And we also saw most recently last week, actually, the second final estimate of the first quarter gross domestic product from Japan, which only confirmed to even the non-believers that the Japanese economy registered its third recession in a decade. Yes, Japan has officially registered now 3 recessions in 1 decade. So with all of these factors in play, as I have been saying this for weeks, if not even months, the Bank of Japan is perceived to be the last in line of the major central banks to consider tightening their monetary policy, which is extremely accommodative, extremely loose monetary policy. They're the last in line to consider tightening it anytime soon. So that's why I'm expecting that it's 99.9% that the Bank of Japan, in my opinion, is going to keep interest rates at their current low level, record low level, by the way, which is a target band between 0 and 0.10%. That's where the current low interest rate is for the Bank of Japan, and more than likely it could stay there. Obviously, the Japanese yen is considered as a safe haven currency in periods of risk aversion. As we said, we can see these higher yielding commodity currencies such as the Australian, New Zealand dollar and so forth strengthening, or weakening rather. It is the opposite with the Japanese yen, where the Japanese yen in periods of risk aversion, being a safe haven currency, actually tends to strengthen. The reason why that happens, and although the US dollar is also considered as a safe haven currency, when it comes to the relationship in periods of risk aversion between the dollar and the Japanese yen, the relationship is that the Japanese yen tends to strengthen more than the US dollar, and investors, at least in recent years, prefer to hold the Japanese yen over the US dollar in periods of risk aversion. The reason for that is the ability of Japan to finance its own debt internally, rather than, because it runs an account surplus, rather than rely on external sources for financing, such as the U.S. government, which always has to rely on external sources, for example, China, which is the biggest buyer of U.S. government debt. So we got to see, with risk aversion coming in again throughout the last couple of weeks, the U.S. dollar failing to break above recent resistance, which is at 82.23 yen. We even drew the lines here a few weeks ago so that you can visualize the range that I said is now establishing for the dollar against the Japanese yen. The bottom of the range is the previous low from May the 5th at 79.56 yen, and then the top of the range is the recent resistance at 82.23 yen. For the most part, once again, here is another currency pair, major currency pair, whose exchange rate has been pretty much stuck for a few months, or at least throughout the month of May and June so far. It's pretty much stuck in a range of a large quarter, give or take. And that is the large quarter between 80 yen and the large quarter point at 82.50. Obviously, 2 very important price levels in my quarter theory. So, after the dollar versus the yen failed to break above that resistance, above the top of the range, we now in the last couple of weeks have seen the dollar come under pressure and targeting the bottom of the range, with recent low established on Wednesday of last week at 79.70 yen, which is only 14 pips above the bottom of the range at 79.56. Needless to say, that bottom of the range is once again going to be the price level that we're going to watch. Because if the bottom of the range is broken next week, we get to see more risk aversion and the dollar under additional pressure. If that bottom of the range is broken, then the market could make the push to the large quarter point at 77.50 yen, which is going to be a little bit ahead of the ultimate support level at 76.34 yen, which is the the new post-World War II low for the dollar against the yen that was established in the aftermath of the Japanese earthquake in March. And after that level was established, the Bank of Japan had no other choice but to step in and to intervene in the currency markets to curb the strength and rapid appreciation of their own currency, the Japanese yen. And the Bank of Japan's efforts were also supported by other major central banks. So it was not a unilateral intervention, it was a multilateral intervention, which proved to be successful maybe for a couple of weeks. After that, ultimately, we saw the US dollar continuing to drift lower and lower, and now the potential, if that bottom of the range here is broken below, the potential for another intervention is going to increase exponentially if the Japanese yen continues to strengthen further and begins to approach these previous lows. Now, over here we have support at 78.82 yen in a day after the actual intervention. So that's another important level that we're going to watch here, a little bit below the 79 yen level. And then after that is the large quarter point at 77.50, and then is the post-World War II low at 76.34 yen. Now, that is the bearish scenario for the dollar against the yen, which relies on a dollar-yen currency pair, breaking below that bottom of the range, that strong support here at 79.56. What would be the bullish scenario for the dollar against the yen? Well, if the bottom of the range sustains and the dollar-yen pair does not break below that level, then obviously that could open the door for another move higher, which could more than likely challenge the top of the range. After all, we know that in a range-bound environment, we don't necessarily have any kind of a trend direction because prices are fluctuating in a range. They're basically trading sideways and they're trendless, but that still doesn't mean that those kind of ranges and range-bound trading cannot create any opportunities. For example, if prices were trading in the middle of the range, that may not be of much of an interest to me. But if prices are approaching either the top of the range or either the bottom of the range, there may be a much better opportunity at that point, especially if the bottom of the range is either broken, which opens the door to possible further weakness, or if the bottom of the range sustains, and then we get to see the dollar strengthens from that point on and targets the top of the range, which is 82.23. So there you have it, the two scenarios, bullish and bearish, that we're going to watch for throughout next week for the dollar against the Japanese yen. And that's going to lead us to our next spotlight event, which comes after the Bank of Japan's interest rate announcement, which is another inflation report, this time from the United Kingdom with the Consumer Price Index there. Consumer Price Index is the preferred measure of inflation by the Bank of England. And we know that inflationary pressures in the UK have been very strong, very elevated. Recently, in April, they came up to 4.5% year over year. And the consensus forecasts are expecting another month of elevated pressures in May, with inflation at 4.5% year over year in the month of May. So obviously that's two consecutive months where inflation in the UK is expected to be at 4.5%. Considering that the Bank of England, as many other central banks, prefers to keep inflation near 2% level, that is the comfort level for the majority of major central banks, where they like to see inflation near. At 4.5%, you can see that its inflation in the UK is significantly above that 2% level. That's the target. On top of that, the Bank of England does not like to see inflation above 3% because that is the so-called ceiling that the Bank of England prefers not to see inflation breaching above. Well, unfortunately for them, inflation has stayed above 3% for many, many months, pretty much throughout the entire 2010, and so far throughout 2011 as well, for the majority of 2010 and throughout 2011. So what does that mean? Elevated inflationary pressures that are well above the comfort levels above the ceiling have increased the odds in recent months that the Bank of England will hike interest rates. But I on this program said for the last several months that it is not enough for us to only see inflationary pressures remaining elevated. I required another second factor that we needed to see and requirement that we needed to see met. What was that? Well, those of you who listen to this program on a regular basis will probably remember that I required also for the UK economy to show strength and not weakness. As I explained previously, if inflationary pressures are elevated, then the odds for the Bank of England to hike rates will increase. But on the other hand, if the economy shows weakness and even begins to show a slowdown or even a contraction, then that would not be the kind of an environment where the Bank of England policymakers will be comfortable as far as considering to hike interest rates. So we have to see those two requirements being met. Rising inflationary pressures coupled with strong economy. Unfortunately, however, for the hawks at the Bank of England, who have been calling for interest rate hikes, and there's three Bank of England policymakers who have continuously voted in the last several months for an interest rate hike. Unfortunately for them, however, the economy has been showing signs of weakness. And that, as we explained previously, does not create the appropriate environment where policymakers will be comfortable raising interest rates. On top of that, we are now starting to see the effects that we also have discussed of the massive spending cuts, the so-called austerity measures that the United Kingdom government is undertaking. They are undertaking the largest spending cuts and austerity measures since World War II in the UK, which we explained months ago could have a negative impact on UK economic growth and consumer spending along with that. On top of that, there's an increase in taxes in the UK. The sales tax went from 17.5% to 20%, which also impacts negatively consumer spending. So therefore, we have now seen the Bank of England chances for them to raise interest rates being dramatically reduced. And although inflation is expected to remain elevated, the pound could find some support from that CPI report on Tuesday, provided it comes high at 4.5%. If it starts pulling back, however, if that number is lesser than 4.5% year over year next Tuesday out of the UK, I feel that the British pound could come under some additional pressure, especially versus the US dollar, where I will show you. And now let's go ahead and take a look at the daily chart of the pound dollar pair. And I'll show you what I mean by saying additional pressure for the pound versus the US dollar. If the consumer price index report shows inflation lower than 4.5% next Tuesday. Now, in recent several days, whether it is risk aversion or pound weakness in economic data, weakness in equities, all of these factors came in play to cause weakening of the pound versus the US dollar. The pound, after reaching as high as $1.6546 here, has actually fallen. Hold on one second. $1.6546 was the high on May 31st. The pound has fallen from that high to now reach as low as $1.6219 in a trading session of Friday, which is a little bit below the large quarter point at $1.65. Or $1.6250 rather. So that area is now going to be an important area of support, because if the pound breaks next week and the consumer price index report does not help the pound as far as its strengthening versus the dollar, we could see further weakness, and we can see this currency pair beginning to work on the next large quarter of 250 pips, which will be the large quarter between $1.6250 and the major large quarter point at the $1.60. And then just a little bit below $1.60, you would recall that we had the ultimate short-term support level, which is at $1.5937, which is also serving us now as the bottom of the existing range, where the pound-dollar exchange rate has been stuck within since February of this year. That range is the two lines here that I drew for you weeks ago, if not even months ago, where the pound-dollar pair has been trading within for months. And that is the range between $59.37 and the recent highs at $67.45, which is only 5 pips below the next large quarter point there at the $67.50. So for the most part, most of that range is about, I would say, a little bit over 800 pips of a range, within which there's three large quarters of 250 pips, between $1.60 to $1.6250, $1.6250 to $1.65, and then $1.65 to $1.6750. As I explained a few weeks ago, that high at the $1.6745 was not a coincidence. It was the large quarter point at the $1.6750 there serving as an area of resistance. The pound did not break above it, established resistance there, and now this is the new top of the range for the pound versus dollar. So again, at these levels here, the pound is still pretty much in the middle of that existing range. So I'm not that interested in currency pairs that are range bound and trade in the middle of the range, as I mentioned earlier with the dollar versus the yen. When we approach the top or bottom of a range and you have a range bound environment, that's when I might get a little bit more interested. But for those of you who follow the pound versus the dollar, I would watch next week the behavior of the pound-dollar pair at the large quarter point. If it starts breaking decisively below $62.50 large quarter point area, it started moving below that area on Friday, as you can see. It broke below the last week's support, or that was the week before last week's support, which was $62.84. We now have a new low to $62.19. That's a support level from Friday. That's what we're going to watch going into the new trading week ahead of us. And if the UK Consumer Price Index is not as high as forecast, if on Wednesday as well we have another spotlight event from the United Kingdom bringing us the jobless claims and unemployment rate, if that is not a positive report and shows weakness in the United Kingdom's labor market, then those could be the catalysts for the, and of course, if that's all coupled with uncertainty in the markets, risk aversion, as I explained earlier, that could continue to weigh on the British pound further, that could be the catalyst for the pound-dollar pair to move down towards the bottom of its existing range. Before the $1.60 level, it's important to note that we have a support level at the $60.58. That's the low that was established on May 24th. That's another price level that we can watch below $62.19 support here, below $62.50 large quarter point. If these levels are broken below, we can see the door open, at least, if not to $1.60 level, at least to $60.58 support to be possibly challenged next week. And that is the bearish scenario, obviously, for the pound against the US dollar. You will see here a lot of sideways activity. It looked more like a descending triangle rather. The two walls of the triangle are, one is descending and one is ascending, and it's more of a actually not a descending triangle, but rather a symmetrical triangle here, which is a potential sign that there's going to be a breakout. And if you were to connect these descending lows with the ascending highs, then the two walls of the triangle meet at one point, and it's a signal when you see these kind of symmetrical triangles that we could be getting ready for a possible breakout. The problem is that with symmetrical triangles, we cannot really say with a much greater probability of accuracy in which direction the actual breakout is going to be. One can go, I normally tend to go and say, well, it's probably going to be in the direction of the existing trend. Well, the existing trend for the pound against dollar has been somewhat bullish, but in the last couple of months we have had a little bit of a range. So after this symmetrical triangle, the breakout was not a bullish breakout, it was actually a bearish breakout. Okay, so we're heading now, looks like we got a greater probability to be heading lower rather than higher as a result of that formation here. as we have noted on Friday. So we'll watch the British pound throughout next week on Wednesday of next week. And let's go to the major spotlight events, and I will show you the next spotlight event, which is going to be from the United States with the U.S. retail sales. And then after that, we're going to see the UK jobless claims and unemployment rate coming up on Wednesday at 4:30 a.m. Eastern Time. And then on Thursday, also out of the United Kingdom, we're going to have the retail sales, which is an important measure of consumer spending in the UK. So if the jobless claims and the retail sales from the UK are not positive reports, then that could serve as a catalyst for further pound weakness, because as I explained earlier, it's not enough for us to only see rising inflationary pressures in the United Kingdom. We have to see the economy showing strength to make the environment comfortable for the policymakers of the Bank of England to hike interest rates. But that is not what we have seen in the recent couple of months. Speaking about retail sales, that's an important gauge of consumer spending in another economy. Just as the United Kingdom's economy, the U.S. economy is very dependent on strong consumer spending. And the U.S. retail sales could be another one of those disappointing U.S. economic reports that show weakness in the U.S. economy. We got a very disappointing jobs report with the non-farm payrolls coming much, much less than initially forecast. Then we had all sorts of other indicators showing us signs of weakness and slowdown in the U.S. economy. And the retail sales may not be an exception to that trend, with consumer spending expected to contract, with retail sales dropping by 0.3% month over month, according to the consensus forecast. In the month of May, 0.3% drop. That will be down from retail sales being up by 0.5% month over month in April. As I mentioned earlier, that could be a weak retail sales and economic report from the United States. That's going to lead us to the UK jobless claims and unemployment rate, the main gauges of employment trends and labor market conditions in the United Kingdom, coming up on Wednesday at 4:30 a.m. Eastern Time. And we had a much larger than expected increase of 12,400 jobless claims in the UK in the month of March. But according to the consensus forecast, we might see half of that as far as an amount for new jobless claims. Those are, of course, new claims, new first-time claims for unemployment benefits. In the month of April are expected to reach 6,000, which would be 50% less than the amount we saw in the month of March. So that might be a slight improvement if that is the outcome of the jobs report, the jobless claims report from the UK. On the other hand, however, if that number is larger than 6,000, if the jobless claims are a disappointment and the unemployment rate is expected to stay unchanged at 7.7%, if it were to peak higher, that would be a catalyst for further British pound weakness on signs of a weakening jobs market there in the United Kingdom as well. Later on Wednesday, another spotlight event coming from the United States with the Consumer Price Index. This is not the preferred gauge of inflation by the Federal Reserve, but it is the official measure of inflation in the U.S. The Federal Reserve here prefers the so-called Personal Consumption and Expenditures Price Index, which is an index that measures a variable basket of goods and services, as opposed to the Consumer Price Index, which measures price changes in a basket of goods and services that is fixed. So the Fed prefers the PCE price index, but nevertheless the Consumer Price Index is an important measure of inflation. And in the United States, inflationary pressures have not been as strong as they have been, for example, in the United Kingdom. But in recent months, with food and fuel costs, energy costs increasing, that obviously is inflationary, puts inflationary pressures higher in the United States. Fed Chairman Bernanke, however, has come out and said that this is just a transitory, to quote his words, transitory increase in inflationary pressures. After commodity prices pull back, then that's going to ultimately lead to the U.S. inflationary pressures to start subsiding once again. Well, we might actually see exactly that, with the consumer prices in the United States expected to reach a reading of 0.1% only increase month over month in the month of May. That would be down from being up 0.4% month over month in April. So if that transitory expectation by the Federal Reserve is confirmed with the consumer price index next Wednesday, what would that mean for the market's expectation as far as gauging future monetary policy by the Federal Reserve? If inflationary pressures are not rising fast and remain rather subdued here in the United States, then we know that the Federal Reserve will be in no hurry to start exiting their ultra-accommodative monetary policies. That means that rates could stay low for, quote, extended period. And obviously, that could continue to weigh on the U.S. dollar if the Fed is not in a hurry to start exiting their accommodative monetary policy. So, consumer price index could be a little bit lower in the month of May, according to the forecast. Only 0.1% increase compared with 0.4% month-over-month increase in the month of April. Following the U.S. Consumer Price Index, we're going to see the Swiss National Bank interest rate announcement on Thursday morning, and that, as I mentioned earlier, would be another major central bank that is not in a hurry to start raising interest rates, in my opinion, especially after consumer inflation in Switzerland came out flat. 0% month-over-month increase in inflationary pressures in Switzerland in the month of May. That is coupled with a extremely strong Swiss franc, which is enjoying its multi-year bullish trend versus a variety of major currencies. So with continuously strong Swiss franc and flat consumer inflation in May, I'm not seeing any kind of urgency for the Swiss National Bank to make any changes to their interest rates and their current monetary policy. More than likely, they're going to keep rates unchanged in their record low range around 0.25%. Their current target band is between 0 and 0.75%, with the benchmark rate maintained at 0.18, 18 basis points or 25 basis points area. So, what does that mean for the Swiss franc? Well, the Swiss franc is benefiting from that risk-averse market environment. It's no news to anyone who listens to this webinar on a regular basis. We've been talking about the Swiss franc for months. This is a multi-year bullish trend for the Swiss. It's not something that developed a couple of days ago or a couple of weeks ago. It is a multi-year bullish trend, and in my opinion, the only thing that can reverse the strong Swiss franc trend versus a lot of majors, especially versus the U.S. dollar, would be the Federal Reserve exiting their ultra-accommodative monetary policies. But with the Fed not in any hurry to start doing that, and with uncertainty and market jitters persisting, the Swiss franc could enjoy at least a few more 100 pips, if you will, possible gains versus other currencies. That's going to lead us on Thursday morning to the Eurozone Harmonized Index of Consumer Prices, which is another gauge of inflation. To give you an example why, I mentioned earlier that one of the main themes of next week is going to be inflation besides the European Union debt crisis. The Eurozone Harmonized Index of Consumer Prices showed us in April that inflation was at 2.7% year over year, which was a little bit less than 2.8% in March. We're expecting for the month of May, according to the consensus forecast, that inflation is going to stay at 2.7% year over year in the month of May. Last week, we saw the European Central Bank, as expected, by the way, last Sunday, I spoke about the euro possibly seeing some profit-taking coming under pressure if the European Central Bank interest rate announcement and statement following it were not to be perceived as very hawkish, which it was not. It gave an opportunity for a lot of traders to square off some long positions on the euro. More uncertainty, more concerns now that we're approaching the week ahead of these important events from the Eurozone with the clock ticking. 4 solutions to the European Union debt crisis. I don't really think that the Eurozone harmonized index of consumer prices, although 2.7% is still above the 2% target that the European Central Bank has. I think that for the most part, the market may have already priced in the expectations that the European Central Bank would hike interest rates in July, and that after that there may not be in any hurry to continue raising interest rates further if they were to hike in July. So as the deadline for new solutions to contain the debt crisis in the Eurozone approaches, uncertainty and pessimism about the outcome of the Eurogroup finance ministers meeting on June 20th and also the European Union summit on June 23rd and 24th could weigh on the euro next week. Now, if we get to see decisive announcements and clear solutions, long-term solutions to contain the debt crisis, for example, one of the options, in my opinion, is the European leaders to provide what the U.S. Government offered here to deal with the debt crisis, a shock and awe type of an announcement and strategy, where multi-billion and trillion plus type of financial backstop is provided to contain the debt crisis and improve investor sentiment. Now, if that's what we hear a couple of weeks from now from the European Union leaders, then that would obviously be a tremendously positive announcement for investor sentiment. And we could see the euro rally very strongly on that type of an announcement. But are the European Union leaders capable of doing that? That is the uncertainty. Are they capable of dealing successfully and containing the debt crisis? Because they patch things up, and then a few months later, another country asks for a bailout, and then later on, a country gets bailed out, such as Greece, and then they line up for another bailout, and then potentially there's a potential also for restructuring and so forth. And that's considered by some, at least, of the credit ratings agencies as a default. And the ball keeps rolling, and these are just temporary solutions that we have heard so far. So we need concrete solutions. We need aggressive action, and the type of a shock and awe type of an announcement to contain and improve investor sentiment, to contain the debt crisis, and to really help these higher yielding currencies, including the euro, to continue their bullish trends versus other majors like the US dollar, for example. Now let's go ahead and take a look. But if that's not what we see, obviously, that could weigh on the euro. Let's go ahead and take a look at the daily chart of the euro versus the US dollar and see what the situation is there. Now, we have seen the euro-dollar pair also pretty much stuck in a range recently. The highs here were at $1.49.37, wasn't it? $1.49.39. Recently, the euro managed to strengthen from around the $1.40 area, went as high as $1.46.96, a little bit below the $1.47 level. And in the last several weeks of the trading week last week, the euro went as low as $1.43, $1.43.22. Now, this was the area at the $1.43.5 approximately that the euro-dollar pair is now moving back towards. $1.43.5, you would recall, we discussed a few weeks ago, was an area of resistance that the euro was challenging, and then it broke above it, completed the quarter. We said if the euro broke above $1.43.50 resistance, we could easily see it moving to $1.45. Then it challenged this resistance a little bit above $1.45. These levels here at the $1.45.20, broke above them, and it moved almost to the $1.47 area, but established a double top resistance a little bit below $1.47 with two identical highs at the $1.46.96 and then a $1.46.94. After that, the euro came under pressure once again. The European Central Bank did not help the cause, and we have now started to see the euro back to the $1.43.5 area, which is the area of support. We overshot below $1.43. To give you the exact numbers, the resistance previously was $1.43.39 and then $1.43.45. So that's $1.43.5 area that we discussed. We overshot below these numbers on Friday with an intraday low on Friday at $1.43.22. But that's not the decisive breakout that I normally require. Any moves below 25 pips or less is what I consider as an overshoot and not a decisive breakout, which could ultimately lead to head fakes, and you know what happens as a result of fake head fakes or fake breakouts. You get to see moves in the opposite direction, targets a lot, triggers a lot of stops from traders and so forth, and they end up with when the stops are triggered with losing trades and so forth. So I would require a more decisive break below this support area, below $1.43.5. That could open, if that were to happen, that could open the door to the euro-dollar pair moving to the large quarter area, point area at the $1.4250. Previously, we had resistance here at the $1.4248. I'm sure that was just a coincidence, or not, being only 2 pips below the large quarter point at the $1.4250. That area can now serve as a level of support. And then if a $1.4250 large quarter points broken decisively below, we could see the door open for the euro-dollar pair to even move to what could now establish itself as a bottom of the existing range, which is going to be approximately the $1.40 area, which is another major large quarter point. This is, of course, the bearish scenario for the euro. Now, if the euro finds a base and forms a base around $1.43.5 area and does not break decisively below this area, then we could see it bouncing higher, moving back to $1.47, breaking above $1.47 resistance, completing the quarter to $1.4750, and then depending if it breaks above the large quarter point at the $1.4750, we might even see the door open to $1.4939. That's the bullish scenario that's only going to depend on significant, strong, aggressive measures to contain the debt crisis. If the European Union leaders are capable of giving us that, the euro could rally and that bullish scenario could occur. But if we get to see more uncertainty, more disagreements between the European officials, more investor concerns about the debt crisis continuing going forward, Greece defaulting and possibly other countries not only lining up for bailouts but also in the near future defaulting as well on their debt, that is going to be the bearish scenario, obviously, for the euro. Now, we have a few more spotlight events to cover. A couple of more events toward the end of the week are going to come from the United States with the U.S. housing starts and jobless claims. We had a disappointing housing starts report last month. In April, we saw a disappointing drop to 520,000 jobless claims. Now we could see a little bit of an improvement with housing claims, but housing starts rather, with housing starts rising up to 535,000 in May. For the most part, that's not going to be very impressive, however. We know that the jobs market here in the U.S. is very weak, and that's also the case with the housing market in the U.S. Speaking about the U.S. job market, the jobless claims are expected to reach 421,000 from 427,000 in the previous week. That's still pretty far from 375,000 for months here, like a broken record. I've been saying that economists are estimating that jobless claims must decline below 375,000 in order for us to see a significant decline in unemployment and significant improvement in the U.S. jobs market. At 427,000 or 421,000, we're not close to that 375,000 level. When we get close to that, that would be positive type of development. When jobless claims continue to linger above 400,000, that's unimpressive to me at least. And then the final spotlight event, which could be another unimpressive U.S. economic event next week, could come from the U.S. consumer sentiment. In May, the consumer sentiment was at 74.3. the consensus forecast is for a pullback to 73. No surprise there. We know that U.S. economic data has not been very strong as of late, and the consumer sentiment obviously could weaken as well as a result of the economy slowing down, the jobs market not doing well, and then on top of that, rising food and fuel costs are also hurting consumer sentiment and outlook, and also consumer spending ultimately. So it looks to me like a week of unimpressive U.S. economic data, and if the market jitters continue to persist on the outcome of the meetings the week after next week, we could see more risk aversion, so be aware of that. That is all the time, unfortunately, that I have for today. Thank you very much for attending the webinar. I need to wrap things up, and I know that two of you are sending some questions. Let's take a close look. Do we have a minute? If we have a minute, I'd like to take a look at these questions very quickly. The first one is says, I just don't see any way Greece can possibly pay back the bailout without defaulting. How far do you see the euro falling under the scenario? And do you agree that it will start a chain reaction that could lead to the breakup of the euro due to the costs? Well, that obviously, I agree. It could have a very tremendously negative impact on the euro. But on the other hand, the European officials realize that. And I think that they wait until the last minute. At least that has been the case, with them waiting until the last minute until they offer or announce any kind of new solution. So that's why we have to be patient, and we have to see what comes the week after next week with these meetings, the Eurogroup meeting on June 20th and the European Union Summit on June 23rd and 24th. And then after that, we'll get a much better idea whether there is the resolve and whether the European leaders are going to be capable of giving us that kind of a shock and awe type of support and scenario that will be bullish for the euro. If the market is disappointed and investors are disappointed at what comes out the week after next week, the euro could easily fall back into the $1.30s. It's currently trading in the $1.40s, the 1,000 pip range between $1.40 and $1.50. But if there's major disappointments, the euro could quickly fall into the $1.30s. And if it completes the entire $1.30s and breaks below $1.30, then it could go into what many experts say is the fair value range for the euro versus the US dollar, which is between $1.15 and $1.20. That is the estimated fair value range for the euro-dollar exchange rate. And the other question is on the euro-dollar currently at the $1.4334. Where does one draw the lines in the quarter theory? Every 25 or 250 pips from the next round price? It is from the major, not round numbers. The proper way to call them in mathematics is actually whole numbers. So the major whole numbers like $1, $1.10, $1.20, $1.30, they're represented in exchange rates with decimal points, of course, for the precision, but they're easily recognizable. So $1.40 is your, for example, major whole number. Then the large quarter point above would be 250 pips above $1.40 at the $1.40 250. Then 250 pips above $1.40 250, you have $1.45, and so forth and so on. Well, thank you very much for your great questions and for your participation in the program today. I appreciate you logging on every Sunday and following along with me to the Outlook, and I look forward to seeing you again next Sunday at 6 p.m. Eastern Time. As I mentioned earlier, make sure to listen to my All Things Forex daily broadcast Monday through Friday on my website, www.allthingsforex.com. Thank you all very much, and I look forward to seeing you again next Sunday at 6 p.m. Eastern Time.